Pegasystems just dropped their Q2 2026 earnings, and they beat consensus on the top line with total revenue hitting 420.7 million, which is up 9% year over year. Non-GAAP net income came in really strong at 59.5 million.
But the stock is taking a hit today because their GAAP net income plummeted 56% to just 13.3 million. And their forward guidance metrics, specifically the total annual contract value or ACV, showed a major deceleration, growing only 7% to 1.62 billion.
Right. So pulling data directly from their Q2 investor presentation, the 10Q filing, and the earnings press release, we basically have a massive divergence here. Top line growth is stalling, but their underlying cash generation is accelerating at an unprecedented rate.
Exactly. It's a classic fundamental dislocation. And our mission for this deep dive is to deconstruct how this legacy enterprise software company is printing record free cash flow while simultaneously flashing these massive warning lights about an AI traffic jam.
Yeah, and we also have to price in this multi-billion-dollar legal shadow hanging over their balance sheet. I mean, if you are a retail investor trying to model out this company's next 5 years, these documents are basically a masterclass in the hidden costs of the cloud transition.
Well, and the very real anxieties of the AI revolution, right? The
Yeah.
macro story of enterprise software in 2026 is playing out right here in the micro details of Pega's financials.
Okay, so let's unpack this structural overhaul first. Total ACV is 1.62 billion, but when you disaggregate that number, the revenue streams are moving in completely opposite directions.
Yeah, they really are. The core engine driving the future is Pega Cloud. That ECV shot up 22% year over year.
Hitting what, 926 million?
Right, 926 million. So it now makes up the vast majority of their total contract value. But conversely, their client cloud ACV, which is where clients run Pega on their own private infrastructure, that declined by 8%.
And traditional maintenance revenue dropped 10%, falling down to 271 million.
Which, sounds like a red flag. But management is actively engineering the decline of those legacy segments.
Oh, absolutely. It's not churn, it's successful migration.
Exactly. When a client abandons a perpetual license to migrate onto Pega's fully managed cloud, there's a recognized lag in upfront revenue. You are basically trading a lump sum payment today for a ratable recurring subscription over 36 months.
Right. It requires a massive change in the underlying business mechanics. I mean, think of it like a legacy automaker. For decades, they sold you a car for a huge upfront lump sum.
Right, and then you pay them an ongoing maintenance fee every time the transmission slipped.
Exactly. But now that same automaker transitions into operating a fully managed autonomous fleet as a service. You don't buy the car, you just pay a monthly subscription for the miles you use.
So in year one of that transition, the financials look terrible.
Yeah, because they aren't getting those massive upfront car sales anymore, and the maintenance bays are completely empty. But by year 5, they've optimized the fleet logistics, right? They're spreading the fixed costs of their infrastructure across 1 million riders.
And suddenly the profit per mile just explodes.
Right.
And we can see the financial manifestation of that optimized fleet in their gross margin. Back in 2019, when Pega was, in the early innings of this transition, their Pega Cloud gross margin hovered around 51%.
Which is pretty standard.
Yeah, standard for that stage. But if you look at the trailing 12 months leading into this Q2 report, that gross margin has expanded to a staggering 79%.
Wow. So for every dollar of Pega Cloud revenue they book, it only costs them 21 cents to physically deliver the compute, security, and hosting.
Right. That is the mechanical leverage of a multi-tenant cloud architecture. Pega doesn't build a bespoke server rack for every new client. They build the core infrastructure once on top of AWS or Google Cloud.
And then each new enterprise client is just logically partitioned into that existing environment.
Exactly. Once you cover the fixed costs of the engineering, the marginal cost of onboarding the next Fortune 500 bank approaches zero. Management explicitly notes that this margin expansion is how they are managing to the Rule of 40.
Right. And for those of you tracking software valuations, the Rule of 40 basically dictates that a company's revenue growth rate plus its profit margin should equal or exceed 40.
So you can grow at 40% and break even, or you can grow at 10% and run a 30% margin.
And by pushing their cloud gross margin to 79%, Pega is heavily insulating the profitability side of that equation. I mean, they've built an incredibly efficient cash-generating machine that can sustain immense enterprise value, even as their top-line growth moderates to that 7% level.
Which brings us to the cause of that moderation. I mean, if the cloud engine is operating at 79% efficiency, why is the total ACV growth rate decelerating?
Yeah, that's the big question, and we found the answer buried in the management's discussion section of the 10Q filing. And honestly, it completely contradicts the prevailing market narrative right now.
It really does. The filing explicitly states, and I'll just quote this, unprecedented changes in the AI market cause clients to delay their purchasing decisions.
Wait, they're directly blaming the current AI hype cycle for stalling their enterprise deals?
Yes, in the first half of 2026. What's fascinating here is the concept of tokenomics. The market basically assumes that any mention of AI automatically unlocks limitless corporate IT budgets.
But the reality is the exact opposite.
Completely the opposite.
So let's figure out why. Because if a CIO knows they need generative AI to stay competitive, why are they freezing their budgets? It has to be the underlying cost model, right? Are these enterprises simply terrified of the blank check required to run these foundational models at scale?
It is entirely about the cost model. When you utilize a large language model, you don't pay a flat fee. You pay for compute based on tokens.
And a token is roughly equivalent to a piece of a word or a syllable.
Right. So every single time a user queries the AI, the cloud provider charges you for the tokens required to process the prompt, and then charges you again for the tokens generated in the output.
Okay, but if I'm an individual using a chatbot to draft an email, the token cost is fractions of a penny. Nobody cares.
Nobody cares at the individual level, yeah. But scale that fraction of a penny across a Fortune 500 telecommunications company. Imagine 10,000 customer service representatives running live, open-ended queries against a foundational model to resolve millions of support tickets every single day.
Oh, wow. Yeah, the token consumption would compound exponentially.
Exactly. And more critically, the cost is non-deterministic. A chief financial officer cannot accurately budget for their cloud spend because they have absolutely no idea how many tokens their employees will consume in any given hour.
Which creates total corporate paralysis?
Total paralysis. And CEO Alan Trefler addresses this head-on in his commentary. He explicitly states that letting large language models do everything is risky and expensive.
He is basically attacking the core thesis of the foundational model providers, arguing that relying on them for raw runtime execution creates massive financial barriers for large enterprises.
Right, and PEGA is aggressively capitalizing on that enterprise cost anxiety.
Hmm.
Their counterpitch is a product suite called PEGA Infinity 26.
And the entire architectural premise of this release is applying AI agents at design time rather than runtime.
Yes.
Okay, let me try to conceptualize this design time versus runtime architecture, because this seems like the linchpin of their entire sales strategy.
Go for it.
So runtime AI feels like hiring an expensive, highly specialized consultant to sit next to your customer service rep all day. Every time the phone rings, the consultant whispers what to do. You are paying that consultant by the minute or by the token.
And at enterprise scale, that consultant bill will bankrupt you.
Exactly. Design time AI, on the other hand, is like hiring that same expensive consultant for just 1 week to write the ultimate heavily optimized instruction manual. Then you fire the consultant. And from that point on, your reps just execute the steps in the manual for free.
That's a perfect analogy. The instruction manual, in this context, is a hard-coded workflow. PEGA allows the client to use generative AI at design time to analyze their business, write the code, and build the optimized process.
But once that application is built, the daily execution runs on Pega's traditional deterministic engine.
Right. It doesn't ping an LLM. It doesn't consume tokens.
The press release highlights this heavily. They are offering predictable outcomes with, quote, no per token cost. They aren't selling the magic of AI. They're selling a cost control wrapper around the magic of AI.
It is a highly pragmatic pivot. I mean, it explains the ACV deceleration perfectly. Clients took a pause in the first half of the year to reevaluate their entire architectural approach to AI, basically realizing the tokenomics were unsustainable.
And Pega just absorbed that pause and is now positioning Infinity 26 as the financially responsible alternative.
Right, for enterprises that need AI capabilities but demand flat, predictable software budgets.
So, if top-line growth is temporarily suppressed while the market digests this tokenomics reality, how is Pega's underlying cash generation hitting record highs? I mean, we need to look closely at the cash flow statements because there is a massive discrepancy between their operating cash and their GAAP profitability.
You really have to separate the accounting reality from the cash reality here. In the first half of 2026, Pega generated $298.2 million in operating cash flow and $288.2 million in free cash flow.
That is an enormous cash yield on $850 million of half-year revenue.
Huge. Yet their official GAAP net income for Q2 was a paltry $13.3 million.
Okay, well, I'm looking directly at the consolidated statements of cash flows, and I have to play the skeptic and challenge the quality of that free cash flow number.
Okay, let's hear it.
We're praising $288 million in free cash, but when you look at the reconciliation, management added back over $82 million in stock-based compensation over the first 6 months.
That's right.
So is this record free cash flow just a byproduct of financial engineering? I mean, they are paying their engineers in newly minted stock instead of actual cash out of the bank. If they had to pay that $82 million in salary, our beloved cash flow metric would take a massive hit. Aren't they just diluting existing shareholders to artificially inflate the operating cash metrics?
Look, it is a non-cash expense on the income statement, but it is absolutely a real economic cost to the shareholder. Stock-based compensation dilutes the equity pool. When Pega issues those millions of new shares to their engineering teams, your percentage ownership of the company shrinks.
Right, it's a hidden tax on the investor.
Exactly. But to determine if this is just a GAAP illusion, you have to trace exactly what management is doing with the actual cash they retain.
Well, they are deploying it into the open market. The filings show management repurchased 8.9 million shares of their common stock for $367.2 million in the first half of 2026 alone.
Right, at an average purchase price of $41.46 per share. The sheer scale of that buyback neutralizes the dilution argument.
Oh, I see.
Yeah, they issued roughly $82 million worth of equity to employees, but they used their core operating cash flow to sweep $367 million worth of equity off the open market and retire it.
They are drastically shrinking the float.
Drastically. They are utilizing that 79% cloud gross margin to generate so much raw operating cash that they can completely absorb the dilution of their compensation structure and then actively reduce the total number of shares outstanding.
Right. So for a retail investor modeling earnings per share, this is a highly efficient financial engine. Even if net income stays flat, earnings per share will grow simply because the denominator, the share count, is shrinking rapidly.
Exactly. And furthermore, they still have $900 million available in their current share repurchase authorization.
Wow. Okay, so what does this all mean when we confront the multi-billion-dollar anomaly buried in the 10Q footnotes? Because you cannot look at Pega draining its cash reserves to buy back $367 million in stock without addressing the existential threat to their balance sheet.
You really can't. Management is operating as if their capital position is completely secure, yet they are months away from a jury trial that could fundamentally alter the company's valuation.
Any retail investor analyzing a mature software company must look past the presentation decks and heavily scrutinize the commitments and contingencies section of the SEC filings.
Always.
Because Pega is currently embroiled in an escalating legal battle with Appian Corporation.
Right. It originated as a defamation and trade libel lawsuit, but the financial demands have spiraled into an absolute monster. The trial is scheduled for November 2026.
And the 10Q outlines that Appian is seeking $41.9 million in direct damages and $31.8 million in lost profits.
But honestly, that $73 million is barely a rounding error compared to the disgorgement claims.
Right, and disgorgement is a completely different legal mechanic than compensatory damages, isn't it?
Yeah, it is. Compensatory damages are meant to reimburse Appian for what they allegedly lost. Disgorgement is an equitable remedy meant to strip Pega of the profits they allegedly made through unfair competition.
And Appian is arguing that Pega should have to forfeit the profits generated from 2022 through 2025. They calculate a specific portion of that disgorgement at $109.5 million.
But the filings reveal Appian is further seeking disgorgement of the absolute entirety of Pega's profits across that 3-year window.
A number Appian calculates at $2.33 billion.
Yeah, a $2.33 billion penalty applied to a company generating roughly $420 million a quarter in revenue is an exogenous shock. It would consume their entire cash reserve, obliterate the stock buyback program, and likely force them into the debt markets under severe duress.
Now, as analysts, we have to remain entirely impartial regarding the merits of the lawsuit. The filings make it very clear that Pega vehemently disputes the claims.
Yes, they do.
They maintain they have strong defenses against the counterclaims, they disagree with Appian's entitlement to any recovery, and they believe the $2.3 billion disgorgement claim is simply a tactical effort to denigrate the company.
Right. And the legal posturing from both sides is to be expected. But the critical data point for anyone modeling this stock is the specific disclosure language required by the SEC.
What do they say?
PEGA explicitly states they are, quote, unable to reasonably estimate likelihood of success for either party or a range of possible gain or loss.
Wow. If you are an investor, how do you mathematically model an unquantifiable binary risk of that magnitude? The core business is thriving, but it is operating under an executioner's sword.
Well, you apply a massive risk discount to your valuation model. You cannot simply build a discounted cash flow model based on 79% cloud margins and assume a linear path.
Because if PEGA wins the jury trial in November or settles for a nominal fraction of the demand, that risk discount evaporates overnight.
Exactly. In that scenario, aggressive stock buybacks in the first half of 2026 will look like brilliant capital allocation because they bought back shares while the market price was artificially depressed by legal fear.
But if a jury awards even 20% of that maximum disgorgement claim, the $288 million in free cash flow we analyzed earlier is instantly wiped out. The financial posture of the company would flip from aggressively returning capital to desperately hoarding it.
It proves that corporate resilience is not just about writing great code, it's about navigating profound environmental and legal liabilities.
It creates a fascinating duality for the market to price in.
A duality that perfectly summarizes PEGA's Q2 2026 report. We are essentially analyzing three different companies operating under one ticker symbol.
Yeah, that's a great way to put it. First, you have the operational success story. A legacy enterprise software vendor that successfully absorbed the friction of a cloud transition, achieving massive 79% gross margins.
Right, proving the viability of their multi-tenant architecture.
Second, you have the pragmatic AI vendor, a company that looked at a market paralyzed by the runaway compute costs of large language models and built a deterministic wrapper around the technology.
Selling predictable tokenomics to cost-conscious CIOs.
Exactly. And finally, you have the financial engineering machine, a company generating enough raw cash to aggressively shrink its share count and absorb stock-based compensation.
All while staring down a $2.3 billion legal threat.
The ultimate takeaway for you, the retail investor, extends far beyond just modeling Pegasystems. The next time you see a tech company announce a revolutionary new foundational AI model capable of generating infinite code, consider the actual adoption mechanics.
Because in the real world, technological hype causes corporate paralysis until the underlying economics can be controlled.
Fortune 500 companies will not deploy technology that bankrupts their AWS budget on day one.
If the tokenomics remain volatile, enterprise adoption will remain stalled.
Which leaves you with a critical question to consider for your own portfolio. If unpredictable AI compute costs are already causing major enterprises to delay their IT purchasing decisions, will the ultimate financial winners of this revolution actually be the companies spending billions to build the foundational models? Or will the real wealth be captured by the legacy software vendors who figure out how to build a predictable, cost-control wrapper around all that raw, chaotic power?
Make sure you follow the show for our daily earnings coverage as we continue tracking the real-world financial fallout of the AI transition.